So just read an interesting article in Yahoo Finance on the expectations for what the Fed is going to announce this week after, I guess we've got an FOMC meeting on Wednesday, so that means we're going to have a Powell press conference. There's going to be a press release, which will be followed in the couple weeks later by the minutes of the meeting, which are always more detailed. But the Fed, the FOMC, Fed Open Market Committee, is going to put out a statement about what they're going to be doing moving forward. And it's very important to read what the mainstream Wall Street analysts are predicting the Fed will do, because the Fed is heavily influenced by that, as they've shown in the past. Again, you have to look back no further than 2018 to see how Powell thinks, even in situations like in late 2018 when it was already clear that he was going to need to be cutting rates, from his perspective, in order to continue the bubble and save us from, stock markets reverting and coming back down to earth and, reverting to the mean. Even after that point in late 2018, we got one more rate hike when it was clear that he was going to need to, if anything, start cutting rates. And so why is it that he gave us that extra rate hike? It's because the mainstream Wall Street analysts were pricing in that rate hike. They believed that that's what the Fed was going to do. And so the Fed, if at all possible, does not like to defy expectations. Because when the Fed defies the expectations of the mainstream of Wall Street, that's going to create a little more turmoil and tumult in the markets, and prices will have to adjust. And that's going to create generate a lot more waves than if the Fed just does exactly what's expected of it. And so if the mainstream guys, which actually I believe this article was sourced from Reuters, so I think it's a Reuters article that's being published by Yahoo Finance, if I remember correctly now. So I guess it's the people talking to Reuters. If Reuters is getting the feel and is polling, these mainstream economists and things, and they think that the Fed is going to hike rates once in 2022, and they're going to stop, they're going to finish the taper, they're going to stop QE by March. Well, the Fed, at least for now, is going to give the impression that that is what they're going to do, because they don't want to spook the markets. They want the market to know exactly what's going on and to think that they, that they know it all. The Fed wants to create or maintain an environment of calm and comfort. I mean, this is why they use the term for their policy. They describe it as accommodative. And right now, the mainstream consensus is that the Fed is being too accommodative. But in actuality, by waxing hawkish and acting like they're going to be raising rates and ending QE sooner than expected, they're actually being accommodative for the market, because they are validating what the mainstream of Wall Street is thinking and where they're putting their money. Because these are guys who put their money where their mouth is. The Wall Street consensus represents how people are investing. And so the Fed wants those people to be successful. The Fed wants their investment decisions to work out. The Fed wants the mainstream of Wall Street to do well. And so that's why you're always going to see the Fed try and, at least, in public, live up to the expectations of these people. At least that's how the Powell Fed has acted. Other Feds, when you have different Fed chairs, different people on the board, you might get different behavior. But the Powell Fed, this is the way things go. Now, let me square that with what I've said in the past, though, which is that Powell's never going to raise rates, which I still maintain. He's not going to raise rates. But he's going to act like he's going to raise rates for as long as, the Wall Street consensus wants him to. And then as soon as the Wall Street consensus says, oh, no, we don't need to raise rates. We need more QE. We need QE to come back, and we need rates to stay at 0. Then Powell's going to flip-flop, just like he did after 2018, and go, you know what? Those rate hikes I talked about, I think we're going to put those off. I don't think we're going to raise rates. In fact, I think we're going to restart QE. And he'll pretend like it was his idea, when in reality, he's just trying to conform to what's expected of him. And so, yes, in all likelihood, you're going to see the Fed, the FOMC statement, sound more hawkish when it comes out on Wednesday. Powell's going to try and act tough and act like he cares about inflation during his press conference, because that's what's expected of him. So, when will Powell change? When will Powell flip-flop? My guess is it will be long before he gets to his first rate hike. He will not be able to get nearly as far along in the hiking process as he did back in 2018, in which, you know what, I thought he flew too close to the sun back in 2018. I didn't know how he was going to put that deflation genie, and again, in an asset price sense, not a consumer price deflation, the deflationary genie. I didn't know how that was going to go back in the bottle, but somehow he did. I'll give him credit. I mean, he's not quite the maestro, but that was the only thing comparable to the maestro that we've seen. He saved the bubble, and he's extended it now another 3 years, as remarkable as that is. But will he be able to do that a second time? Well, let's just wait and see. Let's not get ahead of ourselves. Let's wait for that next crash to start, see Powell flip-flop, and then see if he can abate the decline and restart the bubble for a second time. So, what I expect to see next year, probably before Powell gets to his first rate hike, is all of this trouble that we're seeing forecast by Eurodollar futures and by the bond market will probably manifest in the form of a big sell-off in the stock market. We will get exactly 20% down, and Powell will come out and say, QE Infinity 2.0. He'll be in a tight spot because he'll probably be able to end QE initially. But before he gets to that first rate hike, things are going to start to take a turn for the worse. And at least back in March of 2020, he had a couple of points that he could cut interest rates, or maybe if it was 1.25%. I mean, it was almost nothing, but it was something. So he could at least say, hey, we cut rates. They're not going to be able to do that this time. And that's going to be tough for Powell. He does not have really any, ammunition, so to speak. And again, in real terms, does that make a huge difference? No, because it's not like the Fed is going out and directly buying stocks when they cut rates. What it's doing is it's sending a signal to the folks on Wall Street, hey, the Fed has this under control. I don't need to sell. In fact, I can buy more. The effect, more than anything, is psychological. And that's what the Fed is good at. Going all the way back to Greenspan. Greenspan had this, he had this cult around him, and he tried to build this cult of the Fed, that the Fed controls financial markets. He started this after '86, when all of a sudden there was a stock market crash, and then everyone said, oh my gosh, this is it. Okay, here we go, the big next depression. And then all of a sudden everything was fine. And Alan Greenspan got all the credit. And so from then on, people said, oh, well, the Fed's magic, and we're never going to have bad times again. And we really haven't had a sustained period of economic hardship in this country officially recognized since the end of the 1970s. Yes, we've had bad times for people. It's just that it's not reflected in the official statistics or in the historical narrative. And this narrative of positivity and of Fed supremacy is so strong that things like the price-to-earnings ratio for the stock market has been thrown out the window. And nobody looks at valuations anymore. Nobody cares. They just say buy, 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 because the Fed has our back. And so it doesn't matter if these companies are growing or not. It doesn't matter whether or not, the whole story has become, do you believe in the Fed? And for a long time, Wall Street has believed the Fed. But if the Fed is exposed as a paper tiger, then there's a risk that it all comes crashing down. And so I will say, late 2018, early 2019, that was a big test for the Fed. And Powell was able to pass. Give him that. March 2020, another test. And he was able to pass. He was able to maintain this idea that he's in control. But next year, he probably will have to prove that again. And the problem is it keeps getting tougher and tougher every time. It's not like, back in 2008, the Fed had 5% that they could cut. That's a big cut by today's standards. QE had never even been spoken of really in the mainstream of the Western financial minds. I mean, it had been studied because it had been happening. It was a concept that they had for a long time in Japan, so people in the West had studied it. But it was a small academic concern, and the term QE was not even used by the Fed. And so they had all of this magical, newfangled word salad with which to dazzle people and make them feel like they had everything under control. But what new toys, can Powell whip out to impress the boys this time? That's the question we have to ask ourselves. So, with that said, I will see you folks back here tomorrow.